All right, my friends, I'm going to give you an example of how an index annuity works. And actually, this behind me is going to be very favorable to the index annuities. I'm going to share with you why. So we're going to read an article real quick from Fidelity about the index annuities. And I think, look, let's just go into it. We'll see what's... So there's a couple things. You got to remember with index annuities, we got participation rate and we got cap rate. And you'll see here I'm using a cap rate of 8% and a participation rate 60%. And we'll share with you what that means. Cap rate is the upper limit put on the return over a certain time period. For example, if the index returned 10% in a given year, but the annuity had a cap rate of 3%, you would only receive a maximum 3% rate of return because it had a cap rate of 3. The index had 10, you had a cap rate of 3. Participation rate, and I'm using 60% here, is the percentage of the index's return the insurance company credits to the annuity. For example, if the market went up by 8% and you had a participation rate of 60%, or they're using 80%, a 6.4% rate of return. So the market went up by 8, you had a participation rate of 80%, so you got 6.4%, except for the fact you have a cap rate. In their example, the cap rate was 3%, so you'd only get 3%. So a couple things again. The market goes up by 10, you got a cap rate of 3, you're not getting any more than 3. Market goes up by 8, you have a participation rate of 80%, you're getting 6.4%, which is above the cap rate. Okay, does that make sense? So you got to remember there's two things going on here. And again, I'll go over this in real world numbers. We're using a cap rate of 8 and a participation rate of 60%. I think actually the cap rate of 8 is pretty favorable to the annuity, but we're still going to use it. You might get a bonus. I want to talk about one challenge is the insurance company typically have the flexibility to lower the participation rate or lower the cap, which lowers your potential returns, says an actuary from Fidelity. If this happens during the surrender charge period after you've invested the money, you have little recourse. Yikes. That's not good. Can they do that after the contract's been issued? I guess you'd have to look. Do they have the opportunity to lower the participation rate or lower the cap rate? If they do, I would have touched that with a 10-foot pole. And I would have touched these with a 10-foot pole. And here's why. I'll show you in just a second. In addition, an often overlooked point is that for the purpose of the insurance company calculation, an index return excludes dividends. I'm telling you, this is huge, huge. So I did a quick video yesterday, or just about a couple hours ago, about my man from, I won't say his name, but anyway, we'll call him Joe. And Joe said he's talking to a guy who specializes in retirement planning for federal employees. And the guy was saying, we're going to give you the lion's share of the market returns with a guarantee you won't lose money. And the minute he said that, I knew it was going to be an index annuity. And you're not getting the lion's shares of the market returns because they exclude dividends. A return from an index annuity will most likely also exclude dividends. This is important because history indicates that dividends have been a strong component of the returns of the S&P 500. For example, over the past 20 years, the S&P 500 has gained 3.9% annually without dividends and 5.9% with dividends. To further illustrate the point, if you invested $10,000 in the index without dividends in June of 1999, your investment would be worth $21,577 20 years later. Add in dividends and your investment is worth $31,000. That's literally a 50% more rate of return just because the dividends were being reinvested. By excluding dividends in the calculation, the insurance companies are leaving 46% of the return on the table, and that's before considering any caps, participation rates, and spreads. All right, so let's go into this. So they got a 10-year illustration here. I'm just going to use mine. All right. So this is based on the S&P 500. And I'm using -9, -12, -22. This is 2000, 2001 and 2 going up to the end of 2019. All right. And then you can see here, it wasn't down just 9. It wasn't down just 12. It wasn't up 29. I'm just rounding. I think I rounded up or whatever. I rounded 28.5. I rounded to 29. 28.4. I rounded to 28, if that makes sense. And this is with dividends. And remember, index annuities don't include dividends, all right? So just like Fidelity said, no, look, Fidelity's got some skin in the game. They want you to invest in just real markets. That's how they make their money. But with that said, Fidelity also offers annuities as well. So while they are preferred, they prefer just naked accounts, naked with no insurance wrapper on it. They do get paid to sell annuities too because they have an insurance company. So anyway, let's go into this. This is the S&P 500 starting with $100,000 at the end of 1999. All right. So essentially, the next 10 years are probably the worst 10 years. I can't remember if it's worse than the Great Depression or not, but it's pretty doggone bad. Is it worse than the 70s? Might not be worse than the 70s when you factor in inflation. Either way, pretty doggone bad. So what's happening here is the index annuity guarantees you won't lose money. So in this case, we're down $100,000. By the end of 2002, was down. Let's go $100,000 minus 9%, minus 12%, minus 22%, was down to $70,000. So basically $71,000. So we're down 30%. Is that right? Let me do that again. I thought it was like $63,000 actually. Let me try that again. $100,000 minus 9, minus 12, minus 22. That's $62,000. Yeah, so I forgot to hit enter. All right, so $62,000. Yeah, so we were down almost 40% in those 3 years. The index annuity stayed at $100,000 because it didn't lose money. So in those 3 years, you're loving life. Now the next year, the index annuity or the S&P 500 was up 29%, but the index annuity only gives you a 6% participation rate or 8% a cap rate, whichever is more. So we take our trusty calculator and we times 29 by 0.6. That's 17.4, which is much higher than the 8% cap rate. So even though the index annuity gives us a 60% participation rate, and again, this is including dividends, that's more than twice as high as the cap rate. So the only amount we're going to get is $8,000, 8%. Does that make sense? So we have $108,000 because we didn't lose money here. Now the next year the index was up 11%, so we got our full participation rate, which is a little bit around 6% or so, and we're at $114,000. So if we take our trusty calculator, 11 times 0.6, it gives us 6.6, and again I'm just doing for simplicity here. We'll just say 114. The next year the index was up 5%. We have a participation rate of 6. 60% of that, or an 8% cap. So in this case, we have a participation rate of 6% on 5%, which gives us a 3% is what we get, 117,000. So again, you get the lower of the cap rate or the participation rate, whichever is lower. All right. So again, participation rate here we gave us 17.4, cap rate is 8. We get the lower of the two. All right, you can see what's going on here. Now, what happens is in 2007. We were up to $131,000. So we missed all this. We got $31,000 of total growth in the portfolio. It won't be this because, again, you're not getting the dividends. But 2008 comes along and we got hammered. Our $131,000 was down 37%, minus 37%. So we were down to $82,000. So in this case, the index was up $50,000 more than us. People who have the index are saying, you suckers, you sucker, and you're worried about commissions, blah, blah, blah. You should have stayed with the index. Yeah, I paid the guy freaking 8% commission, but I got $131,000. Again, this doesn't include, I guess the commission's already built in. So anyway, it would be, this is all your money going in because they're getting paid on the back end in terms of having surrender charges to pay off the commission if you were to sell early. So anyway, that's $100,000 is worth $131, and just a naked account with no insurance wrapper, we're down to $82,000. So that's a $50,000 difference. Now the next year, we're up 26%, but again the index only gives us 8, whichever is lower, the cap or the rate of return with the participation. So we went from 131 to 141. Keep going down here. Now this is all good years except for right there. All right, 2018 we're down 4%, and you can see we go from 1,452. So again we got less than a little bit more than half, a third, a fourth. Yeah, fourth. Painful to see. Look at that. We got a little bit more than half. We got a little bit more than half. We got roughly 35%. We didn't lose money here, and then we got less than a third, less than a fourth. So at the end of the day, we ended up with $247,000. So we'll say 250 for simplicity at the end of 2019. The market was up 31. We were up 8. I want to take a gander what we would have had if we would have left it in the S&P 500. Now again, this is not including dividends. And going back to Fidelity's saying here, dividends gave us another 46%. So we're way overestimating what the index annuity did. Way overestimating. If we look at the S&P 500, $421,000. 421. So 247 and 421. So even while the index annuity had a $50,000 more here, over the course of the next 10 years or so, we had, we're talking $150,000 more. No, more than that. Almost $175,000 more. 421 minus 247. So now let's say we have a bad year again, and we'll say we have another 37% decline. So 421 minus 37%, we're going to be down to 265. So even if we have another 37% decline, can you see that? Yeah, we'll be down to 265, and that will still be at 247. So even here, we're still $18,000 more. I just don't know how you. I don't, and that's again assuming the index annuity includes dividends, which it doesn't. There's just no way to justify that, in my opinion. And I'll do another one yet tomorrow where I reverse it, where I said reverse engineering. So we start on the front end looking good, and then we get killed on the back end, because this will hurt. Because we have more money in here on the back end, it'll hurt for sure. I have no clue what it'll look like. It'd be interesting to see, but so that's part one of your tutorial about index annuities. And just frankly, why I don't like them, because look, if you're risk averse, just go CDs. You just have to have a naked account with stocks. If you want stock returns, you got to be in the stock market. There's no lion's share of the stock market. There's no stock-like returns. Anytime they say anything with a caveat, stock-like returns, lion's share, less risk, you got to run for the hills, because it's just to get the stock returns, you got to be the stocks. All right, we'll see you.